Wrong life insurance can leave families stuck, stressed, and unprotected. It is a situation no one wants to find themselves in. Quick question: if something happened to you tomorrow, would your family actually have the right kind of life insurance? Or just the wrong policy, too little coverage, or no plan at all? Life insurance can feel confusing fast. Term, whole life, universal life, final expense, group coverage, mortgage protection. A lot of people hear these words and immediately tune out. But here's the good news. By the end of this video, you'll understand the main types of life insurance, how they work, who they may be best for, and what to watch out for before you choose a policy. This is brought to you by David Shelton, an insurance agent, a career recruiter, and marketing executive. Let's make this simple. At the highest level, life insurance is a contract. You pay for coverage, and if you pass away while the policy is active, money called a death benefit goes to your chosen beneficiary. That money can help with things like funeral costs, mortgage payments, and income replacement. It can also cover debt, childcare, or everyday living expenses. Not every life insurance policy works the same way. Some are built to cover you for a set number of years. Some are designed to last your whole life. Some build cash value. Some focus on keeping things affordable, and some are mainly meant to help cover burial and end-of-life costs. So let's walk through the major types one by one. First up is term life insurance. This is the type most people hear about first, and for good reason. Term life insurance covers you for a specific period of time, like 10 years, 20 years, or 30 years. If you pass away during that term, your beneficiary gets the death benefit. If the term ends and you're still living, the coverage usually ends unless you renew or convert it. Here's why people like term life. It is often the most affordable way to get a larger amount of coverage, especially when you are younger and healthier. So, who is term life usually good for? It can be a strong fit for people with young children and homeowners with a mortgage, married couples who depend on two incomes, and anyone wanting to protect income during working years. Let's say you're 35 years old, married, and have 2 kids. You might want enough coverage to replace your income and pay off the house if something happened. That is the kind of need term life is often used for. But term life also has limits. It does not usually build cash value, and it may expire before later life needs come up. So the big idea is this: term life is often best for temporary protection during your peak financial years. Remember these 3: affordable, temporary, and great for income protection. Quick tip: if you're interested in the life insurance space, please subscribe now. David will assist with the licensing fee for random subscribers. Let's continue. Next is whole life insurance. Whole life is a type of permanent life insurance. That means it is designed to stay in force for your entire life, as long as premiums are paid. Unlike term insurance, whole life usually includes something called cash value. That cash value grows over time inside the policy. You may even be able to borrow against it later. Now, when people hear cash value, they sometimes think it means free money. It's not that simple. Cash value takes time to build, and whole life usually costs much more than term life. So, why would someone choose whole life? Because they want lifelong coverage and predictable premiums. They like the idea of building policy value over time as part of a long-term financial plan. Whole life may appeal to people who want guaranteed coverage for life and a fixed benefit. They often prefer stability over lower short-term cost. It's about long-term certainty. For example, covering funeral costs or leaving a legacy gift no matter when they pass. But here's the trade-off: you usually pay more for that certainty. So the big idea is this: whole life is built for permanent protection and long-term structure. Keep these in mind: lifetime coverage, cash value, and a higher cost. Now let's talk about universal life insurance. This is another form of permanent life insurance. Like whole life, it can last your entire life and may also build cash value. But universal life is often known for having more flexibility. You may have some ability to adjust your premium payments or death benefit over time. There are different versions. Some are conservative, others are tied to interest rates. Others, like indexed universal life, are linked to a market index for growth potential. This is where people need to slow down and really understand what they are buying. Policy performance, fees, assumptions, and funding levels all matter deeply. A policy that is underfunded can create major problems years down the road. You might find out years later the policy needs much higher payments to stay active. So who considers universal life? someone wanting permanent coverage with flexibility. Ideally, someone working with a licensed professional who understands the structure. The big idea here, universal life offers flexibility but requires careful funding. Remember, flexible, permanent, and needs careful review. Another common type is final expense insurance, often a smaller whole-life policy. It is meant to help cover end-of-life costs like funeral bills and burial costs. It can also cover cremation costs, medical balances, or other small debts left behind. These policies are often marketed to older adults who want to protect their loved ones. They want to ensure family is not stuck paying out of pocket for final arrangements. One reason it's popular is the simpler application and smaller coverage amounts. Approval may be easier depending on health and age. But there is a catch. Because the benefit is smaller, the cost per dollar of coverage can be higher. It's not usually the best choice for replacing a large income or covering a big mortgage. The big idea, final expense is about easing the burden on loved ones. Keep in mind, smaller coverage, funeral costs, and a simple purpose. Now let's cover group life insurance through work. A lot of people have this already. That's a good start. But many make the mistake of thinking it is enough by itself. Employer coverage is often limited, maybe only 1 or 2 times your salary. For many families, that is not enough, and it may not follow you if you leave the job. That's why workplace life insurance should be seen as a bonus, not the whole plan. The big idea. Group life insurance is helpful, but it often should not be your only protection. Remember, helpful but limited may not follow you and not always enough. You may also hear about mortgage protection insurance and other specialized policies. Mortgage protection is meant to help pay off or cover mortgage needs if you die. In some cases, the benefit may decrease as the mortgage balance goes down. These policies can serve a purpose, but compare them carefully with regular term life. A regular term policy may give your family more flexibility in how they use the funds. Instead of just the mortgage, they could choose childcare, groceries, or debt. The big idea, specialized policies solve one problem, but broader coverage gives more choices. So, how do you choose the right type? Start with these 4 key questions. What are you trying to protect? Income, children, spouse, or your home? Next, ask, how long do I need coverage? Just during working years, or for life? Then ask, what can I comfortably afford each month without stressing my budget? And finally, do I want simple protection or a policy that builds cash value? If your goal is affordable income protection for a set number of years, term life fits. If your goal is permanent coverage and long-term guarantees, whole life fits better. For permanent coverage with flexibility and complexity, review universal life. If your goal is mainly burial or funeral costs, final expense may make sense. And if you only have coverage through work, it may be time to own your own protection. Before we wrap up, here are a few common mistakes people make. First, waiting too long. Life insurance gets more expensive as you get older. Second, buying based only on price. Cheap is not helpful if it doesn't meet needs. Third, depending only on work coverage. It may disappear when you need it most. Fourth, not reviewing beneficiaries. Old listings can create serious problems. And fifth, buying what you don't understand. Ask questions before moving forward. At the end of the day, the best life insurance is not the one with the fanciest name. It's the one that fits your goals, your budget, and the people you want to protect. All policy types have different strengths. The key is knowing what each is built to do. When you understand the differences, you can make a smarter decision for your family. Find the links in the description or visit our website for more information. Thank you for watching. Please subscribe for more insurance tips